Every single headline right now is screaming the same thing. Bitcoin is crashing, bear market, it's over, and Bitcoin just dropped from 126,000 to 60,000. The fear and greed index hit 5, which is one of the lowest readings in crypto history. ETFs are dumping billions and retail investors are panic selling. And the so-called experts are telling you that this 4-year halving cycle is playing out exactly like it always does. But they're wrong. And by the end of this video, you're gonna understand exactly what is driving Bitcoin and why almost everybody is looking at the wrong data. Let me show you what the media is feeding you right now.
And if you've invested in Bitcoin, well, yesterday was probably not the day for you. The value of Bitcoin plummeted.
It is on pace for its 4th negative week in a row. All these tokens far underperforming traditional markets.
The price of Bitcoin is falling off a cliff. The cryptocurrency has lost a whopping 29% of its value this week alone.
Bitcoin peaked at 126,000 in October of 2025, and as of right now, it is sitting around 65,000. That is roughly a 48% drawdown from the top. The Fear and Greed Index, which measures market sentiment, dropped to 5. For context, during the FTX collapse, it was around 11. During the COVID crash, it hit around an 8. We are at historically extreme levels of fear right now. US spot Bitcoin ETFs, the same ones everybody celebrated as the thing that would take Bitcoin to the moon, recorded over 7 billion in outflows in November 2025 alone. Another 2 billion in December, 3 billion more in January, and over 9 billion in leveraged positions got liquidated in a single week. And a lot of people are all pointing at this and saying, see, it's the 4-year cycle. Bitcoin peaked and now it crashes 70 to 80%. And we gotta wait till the next halving. But here's the problem with that logic. The 4-year halving cycle was the gospel of crypto for over a decade. Every 4 years, Bitcoin's mining reward gets cut in half. Less new supply enters the market. If demand stays the same or grows, price goes up. Simple economics. And it worked. In 2012, 2016, and 2020, after every halving, Bitcoin went on a massive bull run within the following 12 to 18 months. Then it crashed. Then it slowly recovered. Rinse and repeat. So everyone expected 2025, the year after the April 24 halving, to be the golden year, the blow off top, the euphoric peak. Instead, 2025 was the first negative post-halving year in Bitcoin's entire history. Let that sink in. The pattern that everybody built their entire investment thesis around just broke for the first time ever. And here's my take. The 4-year cycle was never actually about the halving. It just happened to coincide with something else. And that something else is what's really been driving Bitcoin the entire time. Let me explain. Think about what Bitcoin looked like in 2012 or 2016. There were no institutions, no ETFs, no sovereign nations were buying it. There were maybe a few thousand altcoins in total. It was really just retail investors, regular people like you and me buying and holding actual Bitcoin. And when the halving cut new supply in half, it created a real supply shock, because miners were a huge percentage of the daily selling pressure. When their rewards got cut, there was genuinely less Bitcoin hitting the market. Demand didn't change, supply dropped. Price went up. Basic stuff, right? But look at where we are now. As of February 2025, over 120 million unique tokens have been created. For context, fewer than 3,000 tokens were created between 2017 and 2018, and fewer than 500 between 2013 and 2014. Today, we probably have well over 120 million. The market is completely oversaturated with altcoins. As of early 2026, BlackRock's Bitcoin ETF alone holds roughly 765,000 Bitcoin, worth nearly 54 billion. Strategy owns over 714,000 Bitcoin, making it the largest corporate holder of Bitcoin. Countries like China, Ukraine, the UK, El Salvador, amongst a couple of others, have direct exposure to Bitcoin. And the US now has established a strategic Bitcoin reserve. So this is not a retail-driven market anymore. Institutional buyers now absorb more Bitcoin than miners produce. Let me say that again. Institutions are buying more Bitcoin annually than the total amount of Bitcoin being mined. The halving used to be the single most important event in Bitcoin, and now it's just a date in the calendar. It's not driving the market anymore. What's now driving the market is institutional demand, the business cycle, interest rates, and global liquidity. And this is the part that nobody wants to talk about. Bitcoin's entire value proposition was built on one thing. There will only ever be 21 million coins. Absolute scarcity, right? If you wanted exposure to Bitcoin's price, you had to buy one of those 21 million coins. Every buyer removed supply from the market. Every holder added scarcity pressure. That is what made the halving cycle work. But derivatives changed that game completely. Futures, options, perpetual swaps, leveraged ETFs, these instruments let investors bet on Bitcoin's price without ever touching or owning the actual asset. Think about what that means for a minute. The number of actual Bitcoin is capped at 21 million, but the number of derivative contracts that can be created is infinite. There is no cap on how many paper contracts can exist. So now you have a situation where capital that would have previously flowed into buying and holding real Bitcoin, driving up value through a supply shock, is instead getting diverted into high leverage betting. Investors can make significantly more money through leveraged derivatives than by simply owning the coin. So that is where the money goes. And this does something very specific to the market. It decouples price from scarcity. See, in the old days, more demand meant more buying, right? Which meant less available supply, which meant higher prices. Now, more demand can be satisfied entirely through paper contracts. The demand gets met without a single Bitcoin actually changing hands. This is why we saw the largest liquidation event in crypto history in October of 25. And it's why 9 billion in leveraged positions got wiped out in a single week in February. And these aren't long-term holders selling their Bitcoin. These are derivative positions getting blown up. Leveraged bets completely unwinding. The scarcity of the actual asset doesn't prevent these crashes. When the leverage supporting these paper positions evaporates, the price drops, regardless of how many coins actually exist. The 21 million cap still matters long term, but right now, derivatives are diluting its impact on price action in a very real way. So if the halving isn't driving price anymore, then what is? Well, we talked about it a minute ago. Global liquidity is the first thing. Raoul Pal, one of the most respected macro investors in the world, puts it really simply. Global liquidity explains 90% of the moves in Bitcoin. So let me break it down for you. Global liquidity is essentially how much money is available in the financial system. It's measured by the global M2 money supply, which tracks cash, checking deposits, savings, money market accounts, and similar instruments across all major economies. When central banks print money, cut interest rates, or loosen regulation, then liquidity goes up. More money in the system means more capital flowing into risk assets. Bitcoin is largely traded as a high-risk asset. When liquidity contracts, when the Fed tightens and governments drain their accounts, and the dollar strengthens, then Bitcoin and other risk assets suffer. It doesn't matter how scarce the asset is. If there's no available capital to bid up the price doesn't go up. According to research from Lynn Alden, Bitcoin moves in the direction of global liquidity 83% of the time over any 12-month period. That is higher than any other major asset class. Bitcoin is quite literally a liquidity barometer. Now overlay that with what happened. Throughout most of 2024 and 2025, manufacturing was in contraction. The ISM, which is the manufacturing index, which measures essentially the health of the business cycle, whether it's contracting or expanding, spent 10 consecutive months below 50, meaning the economy was contracting. In December 2025, it hit 47.9. But here's what just happened. In January of 2026, the ISM jumped to 52.6. For reference, the last time it was above 52 was September of 2022, and it hasn't been above 50 in over a year. So the economy just flipped to expansion. And this is a chart that I want you to really pay attention to. When the ISM is above 50, we are in economic expansion. When it's below 50, we're in contraction. Now, if you overlay the ISM with Bitcoin's price history, there is a very strong correlation. We have never had a sustained bear market in Bitcoin while the ISM is above 50 and trending higher. The business cycle and global liquidity, not the halving cycle, are what matter now. And there's a third piece to this that's just as important, and that's interest rates. The interest rate environment is far more indicative of what Bitcoin will do than any halving countdown. When the Fed cuts rates, liquidity flows in. Risk assets like Bitcoin rally. When the Fed tightens, risk assets fall. Bitcoin falls, and risk-off assets like gold and silver and everything go through the roof. which is exactly what we've all seen play out over the last couple of months. And this is exactly what played out when Bitcoin peaked in October of 2025. What else happened around this time? Well, markets started pricing in that Kevin Warsh, Trump's nominee to replace Jerome Powell as Fed chair, would potentially bring a hawkish approach. Tighter balance sheet, potentially higher rates for longer, and the minute that the market sniffed tighter monetary conditions, Bitcoin sold off. Not because of the halving cycle and not because of any crypto-specific event. The US has roughly $8 trillion in debt to roll over in 2026. Now that debt has to get refinanced, and that requires liquidity. And when governments need to manage that kind of debt load, they historically have to debase the currency, which means printing more money. Now, China's already accelerated money printing to stimulate growth. Banking regulations are being loosened to allow banks to buy more government bonds with leverage, which effectively creates money. The liquidity is coming. It always does. The question really is when and not if. Now, this might shift your thinking a little bit. So go back and look at the last couple of bull runs. We can look at 2013, 2017, 2021. What was happening with global liquidity during each of those periods of time? It was expanding every single time. The halvings just happened to coincide with periods of global monetary expansion. The halving was a convenient narrative that fit the timeline. The 2020 bull market wasn't driven by the halving. The 2020 to 2021 bull market wasn't driven by the halving. It was driven by the largest liquidity injection in modern history, the Fed's response to what we all know to be COVID. Same with 2024's rally. The halving happened in April of 2024, but Bitcoin had already hit all-time highs before the halving even occurred because ETF inflows were flooding the market with demand that had nothing to do with mining supply. There's an argument to be made that Bitcoin was never really on a 4-year halving cycle, and it was always on a liquidity cycle. The halvings just happened to overlap. And now that institutions, derivatives, and macro forces dominate the market, the overlap has broken. If anything, we may be looking at something closer to a 5-year cycle now, not based on halvings, but based on the global debt refinancing cycle, the ISM business cycle, and interest rate regimes. So what do you actually do with all this information? Well, first, you stop watching the halving countdown clock because it's probably a distraction. You start watching global liquidity, the ISM, the interest rates. Those are the signals that actually predict where Bitcoin is going, in my opinion. Second, understand what's happening right now. Bitcoin just dropped nearly 50% from its high. Fear is at historic extremes. ETFs are seeing outflows, and headlines are screaming that it's all over. But the ISM just flipped above 50 for the first time in over a year, and it hasn't been over 52 since September of 2022. The US government has $8 trillion in debt that they have to refinance, which will require liquidity. Central banks globally are loosening conditions. Bernstein, one of Wall Street's most respected research firms, is calling this the weakest bear market in Bitcoin's history and is still projecting 150,000 by the end of 2026. They point out that unlike 2022, there's no fraud, no exchange collapse, and really no systematic failure at all. This is a macro-driven correction, not a structural breakdown. That doesn't mean the bottom is in. It could go lower. It can always go lower. But it means the setup for what comes next is fundamentally different from what the fear headlines suggest. Third, own the asset. Stop betting on the asset or using leverage. The lesson from the derivatives explosion is clear. Capital flowing into paper contracts doesn't support Bitcoin's price the way actual ownership does. And if you believe in the long-term thesis, own the real Bitcoin. Stop over-leveraging yourself and trading it. And fourth, stop listening to people who are still using a 2016 playbook for the 2026 market. The game has completely changed. The players have changed. The drivers have changed. Your framework needs to change also. And if you agree with this thesis, then the best way to expose yourself is to stop focusing on what all the news is saying and just dollar cost average over a long period of time. Look, I know the headlines are scary right now, but if you actually understand what drives this market, liquidity, the business cycle, and interest rates, the picture looks a lot different than what the media is telling you. The 4-year cycle is dead, but Bitcoin isn't. Not even close, not if you ask me. If this gave you a new way of thinking about Bitcoin, hit the subscribe button, it would mean the world to me. Share this with somebody who needs to hear it, and drop a comment down below. Do you think the 4-year cycle is really over, or is it just evolving? And I'll look forward to seeing you in a future video.